Well, hi everyone, and welcome to the Buffett and Beyond Research ETF newsletter. And this is November 23rd, 2024, and we're looking at the big stocks on the block and the ones that have been performing so well this year, at least up until the past week or two. But we're up 41% this year to date, just about doubling the S&P 500. So let's take a look at our stocks here, folks. And remember, if you want to live on the beach like Jimmy Buffett once did, this beach right here, you've got to learn how to invest even better than Warren Buffett does now. So let's take a look at our top stocks. We have a dozen stocks that we picked out of the NASDAQ 100, and the ETF for the NASDAQ 100 are the QQQs, or is the QQQ. And so this is year to date as of Friday during the day that we took our measurements, and we can see that the QQQs were up 23.3%, the S&P up a whopping 24.9% this year, which is pretty amazing. We worry when the S&P gets that kind of return, because it's a big return, almost twice as, or a little more than twice as much as it usually does as the average over the past 23 years or so. But our top stocks, so with the S&P up 24.9%, our top stocks that we've taken out of the NASDAQ 100, the QQQs, up 41.8%. So we're looking at about 42% versus 25% for the S&P 500, coming close to doubling the S&P 500. And we're looking at the stocks that you've all heard of. We're looking at Meta, we're looking at Netflix, Nvidia, Google, and Apple. So let's go to the next slide, and now we're looking at year to date for the NASDAQ 100. Now, one of our ways of hedging the portfolio, we use two forms of hedging. One is dynamic hedging, where as the market turns down, we'll get into the SQQQs, which is short, the QQQs, and the other one is that we can be hedged all the time. So we can buy the top stocks in our QQQs, or our top 12 stocks in the QQQs, which have returned 41.8% year to date, and we simply go short the QQQs and leave it on. Now, of course, it costs money unless you're taking some of the money out of this portfolio. So in other words, if you're 100% invested here, then you have to go in and invest about 30% in the SQQQs, or you can go short the QQQs themselves, because the SQQQs are 3 for 1, short 3 for 1. So if you do that, so if you want to be hedged where you're long the top stocks, bottom line, make it simple. If you want to go long the top stocks and short the index itself, you would be up 16.9%. So that is a very, very good return, considering you are almost perfectly hedged. Not perfectly hedged, because these stocks will move up faster than the index and they'll move down faster than the index, but you are pretty much insured almost 100%. So if you want to be short the QQQs or the inverse SQQQs, that's a 3 for 1 inverse ETF, you would be getting a 16.9% return. It's not 41 or 42%, but you are pretty much insured with this portfolio. Very, very nice. Let us go to 5 years. So if we invested in the top stocks over the past 5 years, and this is, we are 1 month shy of 5 years, so I shouldn't say 5 years exactly. QQQs have returned 137%, the S&P 84%, our top stocks 412%. But if we were short, in other words, if we were hedged, fully hedged, we'd be up 24%. So let's look at this in this respect. If we were just long the stocks and took the risk of being just long the stocks, we would be up over the past 5 years, or 4 years and 11 months, we would be up 5 times the S&P 500. 5 times. If we were short and long the top stocks, short the index, we'd be up 274%. That's still 3 times as high as the S&P 500, and we have less risk, much less risk than the S&P 500. Now, let's look at a chart year to date of how some of the ETFs have done. Black line is the S&P 500. And what are these lines up here? Well, they represent the XLU, which is the utility index. Then we have the housing index, and they're all performing about the same as the S&P 500. We have the housing, we have the utilities, and we also have the technology ETF right in here. Now, what are these 3 laggers down here? Well, the semiconductor, if you believe it or not, the semiconductors are down. Well, they're up about 10%, but the market itself and these other ETFs are up 25%. Now, where are our portfolios? Well, let's go over these other stocks here. The XLV, which is the healthcare sector, is just, I don't know why, but everybody's feeling good. They're not going to the hospital, their doctors. XLV is up only about 4% for the year. And then down here, this is oil and gas right here. And so we have 3 ETFs that are really lagging. Now, where are our ETFs? And remember, here they are here, folks. We just went back. Well, this is 5 years. Let's go back 1 year. We're up 41.8%. So let's go back to the chart. 41.8%. We are up here if we're picking the best stocks out of some of these ETFs. So the best stocks, we would be right up here. Now, let's go year to date for our sector stars. In other words, before we took 12 stocks just out of the QQQs, which was the NASDAQ 100. So we took the best dozen stocks out of the NASDAQ 100. Here we have about 18 stocks, and we've taken them out of our favorite ETFs. Up 31.8%, with the market up 24.9%. So pretty decent here, folks. Now, if we were long and short, we would be up 8.4%. Now, you're saying, okay, that's a lot less than the S&P 500. Yeah, but you're almost totally hedged. Now, what about dynamic hedging? With dynamic hedging, we're actually up the same. Now, this is the top 12 stocks in the QQQs. Now we have dynamic hedging, which are used for portfolios, and we are up just about 42% with dynamic hedging. In other words, when the market starts to turn down, we get into a hedge position. When it turns right around and turns back up, we get rid of our hedges. We're up the same as these long top stocks, but we have dynamic hedging, and it's been a pretty good market this year. So we have been hedged several times, but they were only short declines. And so we're doing about the same as just owning these stocks outright and not being hedged. So that's dynamic hedging. Dynamic hedging is working very, very well for us. Now, let's look at if we were totally hedged over the past 4 years. So the 2019, the end of 2019 through the end of 2023, we took all our top stocks, or all our top stocks in our top ETFs that we follow, and there's a host of them, of course, and these would be the returns. We'd be averaging about 35% per year over the past 4 years up until the beginning of 2024 or the end of 2023. Now, if we were long and short to where we're almost totally hedged, we would be up 14.2%. Now, what did the S&P return? 14.3%. But if we were long and short or hedged, we would be matching the S&P 500 with much, much less risk than the S&P 500. How do we know? Let's look at 2022, which was not such a good year. S&P was down 19.6%. The NASDAQ was down 34%. our top stocks in the ETFs that we follow were down 27.9%, which was more than the market. But if we were hedged, we would have only been down 5.1%. Now with dynamic hedging, the way it's been going, we haven't used dynamic hedging in these past years, but had we used it, we would have been up almost 34.9% with the dynamic hedging. So now that is back tested. What I have been showing you in these other charts, they are actual portfolios. So there are ways of getting into the better stocks in the best ETFs in the tech and the semiconductors, to getting into the better stocks, but yet use dynamic hedging to protect those portfolios so that you don't get the dramatic falls that you would if you were not hedged at all, such as in 2022. And in fact, in 2022, we had a lot of portfolios that just went to cash at the end of 2021 because the market, well, here we are again. The market was up 26.9%. And what is the market up now? Almost 25%. So we worry about that following year. And that's why we're happy to have our portfolios hedged, even with the dynamic hedging, or hedged all the time. We like the dynamic hedging much more because it gives us more latitude to make more money and to be hedged at least partially as the market declines. So folks, we had a couple of good weeks, but this past week the market has just been marking time really, because of NVIDIA, which reported earnings on Thursday, or I should say Wednesday after the market closed, and NVIDIA is doing nothing right now because it was up only 96% over last year. Yeah, revenues doubled since last year, but the market was expecting even more than a double, so the market did not react to NVIDIA on the upside. But folks, NVIDIA is up almost 200% this year alone. So yeah, it's been very, very good. So the market's been marking time as the earnings and revenues came out Wednesday after the market closed. But we're going into Thanksgiving this coming Thursday, and guess what? The market likes to go up on November and December during the holidays, because now right after Thanksgiving everybody's going to go out and start buying Christmas gifts, and so the economy really does well. So we're looking for an up market between now and the end of the year. And since the S&P has done so very, very well, we're looking at maybe some hedges going into January. But anyway, go out, forget about the market. It's the weekend, and go for a walk on the beach. If you have a beach close enough to you, go walk in the woods, go walk on the golf course, have Sunday dinner with your family. That would be nice, folks. So you go out, you stay safe, and we'll see you back here in a couple of days.